Let's get right to today's action. We have John Hummel, AIS Capital Management President and Chief Investment Officer. He's warning of a major market pullback. Wait till you hear how much. And Larry Shover's in the pits of the CME. He started early. Larry, I got your notes at about 9 o'clock this morning. We were wondering exactly how the market was going to handle the news from Japan. That they're not going to be printing more yen right now anyway. But we managed to weather the storm better than a lot of people thought we would, even though we ended up with a triple-digit loss.
Yeah, David, you're exactly right. I mean, we have Japan in action, coupled with the fact with ongoing Fed tapering torment. That's enough to cause further de-risking of all assets. People are worried about the wide international price swings, and thus the stocks are for sale. But the real story, David, I think, is that stocks in the U.S. can't be accused of anything right now except for healthy consolidation and digestion. Yeah, there was some offbeat news that came out around the world. However, right now, consolidation, digestion, looking forward to June 19th with the FOMC press conference.
And John, I know you're bearish in the at least in the short term, but today was kind of an interesting day because we did see about a % pullback on most of the indices, but we didn't see that massive profit taking that a lot of people say is coming.
Well, we're more concerned about the intermediate time period. We think that we're living in an artificial environment due to the Fed policy. And the market really has been in a secular sideways bear market since 2000, and we believe we're still there, and we're going to continue in that for at least another 4 years. And because of that, because of the artificial interest rates that we have, and we think profit margins that are excessive at this point and likely to revert back to more normal levels, that we could be looking at at least a 10% correction, possibly as much as 25%, depending upon how things fall out.
Boy, let's not let that comment pass. 25, I mean, I know that's on the high end, but you think it's possible we could have a 25% correction?
Well, if we start to see inflation in the next couple of years, which we think is going to happen, we think that because of all the central bank easing in the developed world, this money is leaking out into the developing world, which is very commodity intensive and growing very rapidly. And what's happening is we think we're going to see much higher commodity prices over the next few years. And these raw material prices are going to come back and be difficult for many manufacturers and companies in the developed world.
Well, Larry, let's look at interest rates for a while. Of course, everybody's worried that the 10-year is going to go up to 2.5. It ended, I think, just about 2.2 today. That's still very low, but when you think of where it was about a month ago, it has jumped about 30%. That's of some concern, right?
Yeah, I think it's concerning to a lot of people, but maybe not the traders behind me. You're right. I mean, I think the 10-year went up like 46 basis points in May alone. However, equities are reacting quite okay with that. It seems like they're moving up for the right reasons, that we're seeing growth, not great growth, but we're moving in the right direction. So again, people are worried about the trajectory that we moved so far so fast, but however, equities don't seem to mind the fact that we're at the levels we're at right now, about 220 for the 10-year yield.
Yeah, it actually came down 3 basis points, ending the day at 2.18, below 2.2. But John, do you think that interest rates are going to be our weakest point in the market right now?
Well, again, on an intermediate and longer-term basis, I think that we're in a long-term trough of interest rates, and it's inevitable that they're going to be rising at some point. The question is whether or not they've run a little too far currently and might back down again. But if inflation starts to develop, as we think it will, we think that interest rates could move up a lot.
Well, if you think inflation is going up, it's not surprising that some of your picks involve those commodities that might be hit by inflation, like fertilizer. Uranium is one of your picks. You like Cameco, which is a uranium company. Why?
Well, because we feel it's inevitable that there are going to be more nuclear power plants. China, for instance, has more power plants on the books and under construction than they currently operate. It's quite possible that Japan is going to have to go back and reopen their nuclear power plants, so that around the world you're going to see plant construction, and there's going to be a heightened demand for uranium.
even after what happened in Japan, and even though the natural gas explosion, and I shouldn't use the word explosion, natural gas substituting for a lot of the coal-fire plants that we have around the world, won't natural gas be a better bet if you think that we're going to switch from coal?
Well, I think we're going to need all the sources of energy that we can find. We're very concerned about the long-term supply of oil. Companies, oil and gas companies globally have been increasing their capital spending by 12% a year, and they've only been able to increase global production by 2% a year. And if you look at the last 6 years, the growth in production globally has been even less than that. So there's serious problems ahead in terms of finding energy of all sorts, and especially at reasonable prices. So I see demand for all of them.
Larry, what about commodities? Do you see the same concern out there in Commodityville in the middle of the country that we are going to have higher inflation as a result of higher commodity prices?
You know, I think John's spot on, and I think to your point, yes. Long term, I think we're going to have what I call inverse stagflation, a continued underperformance of paper assets, stocks and bonds, outperformance of all commodities. Now, I have egg on my face by saying that for what's happened in the last 6 months.
Right.
But I think long term, just given the emerging market around us in the world, I do think we'll have a sustained outperformance of the commodity sector.
Larry Shover, thanks so much, my friend. John Hummel, good to see you as well. And we want to hear from you folks as we've been discussing.